Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Phil Mackintosh, Chief Economist at Nasdaq. And Phil, the question everyone asking is, what's behind this stock market rally? Is it due to retail buying and stimulus checks? What are you seeing in the data?
It's a good question. Obviously the stimulus checks, the amount of money in the system, the low interest rates, the zero interest rate policy, all contribute to upside in valuations. But there is also a lot of data out there that talks about how active retail have become. And just in the last couple of days, there's been some reports that retail trading has increased by around about a third to be almost 20% of one side of every trade. So retail is getting bigger. There was an increase in retail trading back in Q4 last year when a lot of the retail brokers went to zero commissions. But really, we've seen an increase since the pandemic led to shutdown. So there's a theory that stimulus checks have increased people's incomes. A lot of that income actually looks like it's being saved rather than spent because people's spending is actually down. And so maybe people are actually investing in stocks and looking at the level of activity coming out of the non-ATS TRF, which is where a lot of the retail trades get printed. It certainly looks like retail have become more active in trading stocks.
So Phil, what should investors be worried about then?
Well, I think the important thing is that stocks are considered a risky asset and they can go down. So far, you look at the performance of the market since the bottom of the pandemic crisis where the retail trading activity picked up, and it's been a pretty consistent grind upwards. So a lot of people that have entered the market maybe for the first time have seen stocks only go one direction. So it's important that people do realize that stocks can go down. But on the flip side, there's a lot of data that shows that American households generally don't own stock and don't own much stock. And stocks have outperformed housing and they've outperformed bonds over the long term. So getting more people into stock is actually a positive thing, provided they don't fall into some of the classic traps of maybe trading too much or panic selling at the bottom of a sell-off. We want this to be a long-term wealth creation for them. I hope that people are reading about using fundamentals and understanding what people are buying, what the earnings potential is for the company, because valuations are important and valuations are based on the future earnings of companies. So as long as you're fairly confident that the earnings of the company support the valuation that you're paying for now, longer term, that's the way that a lot of professionals invest, and that's what retail investors should be looking at as well.
Phil, your next chart is really interesting because it shows that productivity and wages are up because low-wage people are out of work. You kind of have to dig through the data a bit.
Yeah, this is one of the interesting things. It's an index, so we've got to be a bit careful. It's not an actual level, so it's not like we're at pre-pandemic levels of record production. But the recovery in manufacturing and factory output it looks like it's been pretty close to V-shaped. People have got back to factories and got the factories started up again pretty quickly. What's lagging, though, is the unemployment. So there's a lot less excitement about employing people for factories. That level is still below 50, which means it's contractionary still. And so although factories are back to work, they haven't got all of their employees back yet. They haven't looked to hire more employees. And that's going to be a headwind for the economy. And we've been talking recently about how the economy has a lot of headwinds that the market might not be pricing. This is one of them, because if people can't find jobs 6 to 12 months from now, we might actually have a lot more people still needing Social Security, a lot less income coming into the system, and a lot less spending on services and goods just because people are out of jobs. So it's an important thing to watch. The levels obviously are also important just to make sure that we get a real V-shaped recovery, not just a V-shape in the index and the expectations. But the unemployment numbers this morning do support this result. The ADP numbers came out about half of the expected 1 million jobs created. So it does look like the economy is stalling a little and the recovery is slowing, which has implications for next year.
Let's talk about REITs, rents, and evictions. The Trump administration ordered to halt many residential evictions until the end of the year. It's got to be tough if you're a REIT or a landlord. You still have to pay the bank.
Yeah, this is a really tricky problem to solve, though, isn't it? Because we've kind of forced a lot of these companies to shut down. We've forced a lot of them to run at 50% capacity for indoor dining, for instance. And they're doing the right thing by everybody because we're all in this together, by operating responsibly, but that means that they're going to struggle to pay their bills. And so, this is some data that actually shows the retail industries have had a lot of trouble paying bills. In April, May, it was below 60%. It's been increasing roughly in line with how businesses are coming back. But to your point, the flip side of everybody being given a free pass or at least a discount on their rent is that the guys that are landlords, the companies that are landlords are actually going to have less income themselves, and they might be getting close to having some credit risk and cash flow issues as well, unless the stimulus is enough to sort of backfill them on their expenses as well. Looking into this data in a little bit more detail too, it's not equal across all bits of the retail industry. Fitness and apparel, so retail clothing and movie theaters, obviously a lot slower to get back to work than other industries.
All right, let's wrap up with personal and business auto sales. Certainly one sector that has seen the V-shaped recovery is personal auto sales, as none of us are commuting into the cities anymore.
Yeah, and this isn't just an American trend, it's pretty much consistent across the world. Is one of the things that people have been very slow to get back to is public transit. And people have been buying cars and driving more, but actually driving even more than before the coronavirus crisis and the pandemic-led shutdowns. And so, not surprisingly, the recovery in auto sales has actually been really V-shaped, very quick. But when you dive into the data, you see that it's consumers that have recovered, not business consumption of autos. So it seems like a lot of people are going out to buy cars or second cars to be able to drive themselves to work now, rather than businesses contributing to the growth and the pickup in that part of the industry.
All right, Phil, thanks so much for joining us on Trade Talks.
You're welcome, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.